Hey everyone. So, if you've ever thought about investing, but the second you do, your brain just goes into overload, this is for you. We're going to break down something called index funds, which honestly are one of the simplest and smartest ways for pretty much anyone to get started building wealth. Let's just dive right in. So, here's the game plan. We'll start with the big challenge of investing. Then, we'll get into what an index fund actually is. We'll cover the four huge advantages, see how your money grows. I'll walk you through three super simple steps to get started, and we'll wrap up with the single most important idea you need to remember. All right, first things first, let's talk about the biggest hurdle that trips people up. You look at the stock market and it feels like this massive, chaotic casino, right? There's this intense pressure to pick the one right stock, the next big thing. But honestly, for most of us, that's a losing game. It really boils down to two different ways of thinking. On one side, you have people trying to beat the market. They're hunting for that hidden gem, that one stock that's going to explode. The problem is, even the pros who get paid millions to do this fail most of the time. But then there's a different approach. What if, instead of trying to beat the market, you just matched it and grew along with it? And that, right there, leads us to the super simple solution to this whole investing puzzle. If the goal is just to match the market's performance, how on earth do you do that? Well, the answer is an index fund. So what is it? Just think of an index fund as a copycat. Seriously. It doesn't try to be clever, it doesn't have a genius manager picking stocks, it just buys all the stocks in a major list, or index, like the S&P 500. You've probably heard of that one. It's just a list of 500 of the biggest, most successful companies in the US. The fund's only job is to do exactly what that list of 500 companies does. Simple as that. And here's where the magic happens. When you buy just one share of an S&P 500 index fund, you're not just betting on one company to succeed. No way. You instantly own a tiny little slice of Apple and Microsoft and Amazon and Google and hundreds of other companies, all in one go. So, why do so many experts, from Warren Buffett on down, recommend this strategy, especially for people just starting out? Well, let's break down the four biggest reasons why. First, and this is a big one, they are incredibly cheap. Think about it. Since the fund is just mindlessly copying a list, you don't have to pay a team of expensive Wall Street analysts to do a bunch of research. That saves a ton of money in fees, and all those savings go right back into your pocket, helping your investment grow faster. Second, they are so low maintenance. This is the whole set it and forget it beauty of it all. You don't have to be glued to the news, you don't have to check your stocks every 5 minutes. You just invest and let the overall economy do its thing over the long haul. It saves you so much time and stress. Third, you get instant diversification. This is absolutely crucial. You're not putting all your eggs in one basket. If one of those 500 companies has a total disaster of a year, who cares? You've got 499 others to help balance things out. It's like a built-in safety net. And finally, it's just so beginner-friendly. You don't have to know how to read a corporate balance sheet or a quarterly earnings report. You're not trying to become a stock market genius. You're simply making a bet on the long-term growth of the US economy as a whole. And that's a much easier bet to make. Okay, so you get why it's a great idea, but how do you actually make money? What's happening behind the scenes to make your investment grow? Well, there are two main engines driving this thing. The first one is simple: growth. As all those companies in your fund get bigger and more valuable, the value of your shares goes up too. The second engine is dividends. A lot of these big companies share some of their profits with their investors. Now, you can take that cash, but the real power move is to automatically reinvest those dividends to buy even more shares. That's how you really kick things into high gear. And now, maybe the best part. Getting started is so much easier than you probably think. We can break the whole thing down into just three simple, totally doable steps. Step 1, you open something called a brokerage account. You can do it online in like 15 minutes with big trusted companies like Vanguard, Fidelity, or Schwab. Step 2, inside that account, you choose a low-cost index fund. A classic S&P 500 fund is the perfect place to start. And step 3, you just invest consistently. And I mean it. The habit of putting in a little bit on a regular basis, even if it's just 10 or 20 bucks, is way more powerful than how much you start with. Okay, this brings us to the last, and honestly, the most important piece of the puzzle. If you want to succeed with this, you have to get one core idea into your head. It's not about timing the market, it's about time in the market. This quote says it all, really. You have to stop trying to guess when the market's going to go up or down. Nobody knows. The goal isn't to find the perfect day to invest. The goal is just to invest and then give that money what it really needs to grow, which is time. Lots and lots of time. And you can see why time is the secret ingredient right here. In the first few years, your growth might feel kind of slow. But as you stay invested, something amazing happens. Your earnings start earning their own earnings. That's called compound growth. And over 15, 20, 30 years, it becomes an unstoppable force that creates growth that's almost hard to believe. So if you walk away with anything today, I want it to be these 3 things. Keep it simple. A basic low-cost index fund is all you need. Stay consistent. Just keep adding to it month after month, no matter what. And most importantly, be patient and let time do the heavy lifting for you. Look, investing in an index fund is not a get-rich-quick scheme. It's a get-rich-slow, proven plan. It's about building real, lasting wealth over time. So that leaves us with just one final thought. What kind of gift, born from these small, consistent steps you take today, are you going to give the person you'll be 10, 20, or 30 years from now?